how to trade a bubble. That is the topic for this video. First off, read this disclaimer carefully. This has certainly become a very relevant topic because we do definitively have a bubble in the stock market at the moment. And bubbles are very dangerous. If you look here at the megatrends, you can see that, of course I am happy that these on average are massively beating the S&P 500, but some of these moves are definitively very bubblish, and we are seeing bubblish move in the Nasdaq and the S&P 500 itself, and these are major indexes. Okay, so what to do in these very unprecedented times? So what I thought we would start doing is to look at some of the previous bubbles, two classic ones, the Nasdaq bubble in 2000, the .com bubble, and also the Bitcoin bubble, to sort of see what happens, what are the dynamics, and then I will talk a bit about strategy, to apply to our current times. So here we have the Nasdaq bubble. This is the .com bubble. You see that here is the 100-day, it's daily data points, moving average, and 20 and the 50-day. You can see that here we are more rational. We move in cycles, and then we pull back to some longer-term moving average. Then the bubble phase happens, and we start by roaring really hard, and then we only use the 50-day moving average. Then we go even more ballistic. And in the final phases, you see that we were using here the 20-day moving average as a support level. But otherwise, we were really soaring, and we had some very stretched levels, and we were very far away from the 200-day moving average here, as you can see. So very elevated levels. The problem with a bubble is that because it is so difficult to be a bear, it's very easy to be very skewed in a very bullish direction. Hence, here you bought the dip, here you bought the dip, here you bought the dip, and the big problem, right, is that here, if you look at it when it actually is happening, okay, here, it's very tempting to just buy the dip, okay, and then it goes further down, and then you think it's the deal of a lifetime, because you think about this. But this is what then happens. This created some psychological support, people became a bit more bullish, but then this happens. And this is, the classic dynamics of, a complete change in psychology. And the big problem with this bubble is that it led to a bear market that just continued. For a long time, people were just losing faith. Whenever something bad happened, people just started to panic, and we went down and down and down for a very long time. Okay, so that's one bubble. Let's just zoom out to our current time. Let's take the QQQ like that. Here we are jumping forward to our current times, and this looks even more bubblish than what we saw during the .com bubble, okay? During the .com bubble, we at least tested the 50-day moving average, but here it is the 20-day, 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 20-day. This is extremely bubblish. It's worse than what we literally saw here with the .com bubble. That's something to be aware of, and we saw what happened afterwards. Let's now look at the Bitcoin bubble. Daily data points. So let's look at it in context, okay, to sort of put ourselves in the mindset of the traders at the time. So here we have reasonable times. We're testing the blue 100-day moving average. These are rational cycles. By a support level, you go up. Then the dynamics change. We now start to use the 50-day moving average now as a support level. We don't go any further down. Then it gets even more bullish. Forget about the 50-day moving average. We are now going to stick to the 10-day moving average and the 5-day moving average as a support level. We do not have pullbacks. And of course, when you are here, of course, it's very difficult to be bearish on Bitcoin, and the bullish sentiment is just extreme. And people are thinking to themselves that, you would be a fool to bet against this. But this is exactly the kind of time where you need to become very cautious, because something has changed. Here we are being very rational. Here there is balance. Here it's groupthink in one specific direction. But what happened? You then have a pullback. Then people think that they can buy the dip, like here, it's a support, but then the psychology starts to change. And we go from excessive bullishness to panic. The problem with the bubble is that the emotionality has just changed. Here you have a balance between the bears and the bulls. So good news and bad news are rationally priced in. This creates a healthy dynamic to the market. When the bubble happens, it's distorted, just utterly broken. That's why it becomes so bipolar. And here, you can see that there's red for a long time. The psychology is just utterly broken, and people are now very bearish. Okay, so which begs the question, okay? What kind of a strategy should you have during the bubble phase? Because we are definitively in the bubble phase. If you look at the Nasdaq, if you look at the S&P 500, these are bubbles. They just are. Okay, look at the semiconductors. I mean, we can look at the consumer discretionaries. All of these are acting in a very bubblish manner. One way to, I mean, there are of course multiple strategies. One classic way to trade the bubble is to, okay, you are bullish, you are following the current development, the trend, but you have protection. You can have a protection in the form of puts, or you could have tight stop loss levels. Hence, here as an example, you might use maybe you use like this as your stop loss level, meaning that if you break below this level, then there's an automatic sell order put in, executed. That's another way to protect yourself beyond going for puts. Using stop loss levels it's something that I would say you should more universally use, because they are very beneficial in any kind of market condition. But definitively during a bubble, it makes sense to make them tighter. Another thing that is beneficial is to have a more market-neutral portfolio. So let's say that you have a portfolio with only the S&P 500 and the Nasdaq. You can see here that there's an 87%-ish positive correlation between the QQQ, the Nasdaq, and the S&P 500 ETF. Basically, they move more or less together. Hence, you are not market neutral. If something bad happens to the market, you are really not going to have any kind of protection. One way to deal with that is to have items in your overall portfolio that are less correlated with the S&P 500, or alternatively negatively correlated. If you use investing.com, you can find this statistical correlation indicator that I have here, easily findable. If you go here and you just suck correlation coefficient. So let's look a bit, okay? So GLD is a classic example. So that one has a 55% correlation with the S&P 500, which is much less. The 20-year Treasury bonds, they have a minus 23% correlation, meaning that there actually is a bit of a negative correlation. They move a bit opposite each other. Here you have the Japanese yen ETF. Here you can see that there's a 13% positive correlation with S&P 500, which is very weak. And these are just a few examples, but the key thing is just to find things that are not that strongly correlated. Another thing you can do, which makes your portfolio just inherently more market neutral, that is to have a mix of long bullish positions, but also bearish, short selling positions. This is something that I have presented in some of my recent videos, where I present also bearish strategies, things that can be shorted. Of course, during a bubble, you will get into the annoying situation in which you're short. Let's say that you have 5 short positions and 5 bullish positions. The annoying thing, I guess, is that your short positions will, quickly get stopped out. You will, because you don't want to lose money, so you have a bit of a tighter stop. That can, of course, be annoying. And you start to think, why would I even want to have those short positions? Well, the big benefit is when it starts to turn around, because then you are able to hedge yourself. What happens then, of course, is that your long positions all of a sudden get stopped out. The stock goes down to your stop loss level, and it's closed. While your short positions, they are making money. So that's the thing. So these are just a few of the strategies that you can use. You can have, of course, protections with puts, get into the options market more broadly, look at correlation coefficients, which is a more scientific way to create a market neutral portfolio, and of course, have the long-short portfolio. But the most dangerous thing you can possibly do during a bubble is to think that it will just continue forever, because it doesn't happen. And the psychology, as we saw in the Bitcoin and then the dot-com bubble example, it becomes very distorted, and when people think they can always buy the dip and then it continues to go down, that's when you can get those huge losses. So always protect your profits, don't lose money. That's the #1 rule, don't lose money. Do anything in your capacity to increase your gains, minimize losses. Okay. Whatever you do, of course, don't fight the trend, and also, of course, look at trends in a more bigger picture frame. Don't be completely myopic and zoom in completely on the most recent trend, because even though the most recent trend is very relevant, you need to view the security in its bigger context. And of course, may the trend be with you.